it is also for the central bank a store of value. Right? So whatever reserve asset they keep is a store of value. Everyone was using US treasuries as a store of value. And in 2022, they realized that is not the case. US treasuries is not a risk-free asset because as US rates went up, people had huge losses on these assets. If you would recall, Australia, so RBA, and the Swiss National Bank lost humongous amount of money, right? And I think SNB had a $140 billion loss that year. For the Australian Central Bank, actually their equity got wiped out. So completely. For positive, they went to negative equity. So people realized that over-indexing on just one asset class is also not the right approach, right? So I think these two factors triggered a shift more towards gold within the central bank.
Hi. A lot has been spoken about equity and debt as an asset class, and everybody knows the kind of returns that these asset classes have generated. But did you know that in the last year alone, gold has returned more than 40% in terms of returns? Did you also know that gold is a favorite investment category, particularly for Indians? More than 40% of Indian household assets are in physical assets, and the vast majority of it is in gold and real estate. Today, we will spend some time talking about this asset class and try to understand the evolution of gold and also where gold is headed as an asset class. Joining me today for this conversation is Ashish Gupta. Welcome Ashish to the show.
Yes.
Ashish is the CIO at Axis Mutual Fund. Ashish, thanks for joining us.
My pleasure.
So Ashish, to start with, maybe you can throw a little bit of light on how gold has evolved as an asset class. It's a historical asset class. So how did it come to become one?
So I think any asset, right, or any currency has really two characteristics, right? It is a store of value, right, and it's a medium of exchange,
right?
And from time immemorial, gold has served that purpose. Actually, even before we had currency, gold and other metals were always used as currency, right? So in fact, various metals that were used as currency and they got substituted by gold over the period of time. And initially when currencies came in, when coins came in, the value of coin were determined by the value of the metal in that coin, right? So whether it was silver or gold, whatever the value of that is, of course, over time, as countries and kingdoms determine the value, they start develop credibility. They printed a value on it, and it was not the underlying value of the metal, but it was the value that was imprinted. That became the value of the coin. Gold, for multiple reasons, became really the metal of choice. It had some appeal to it. It has luster. It had durability, right? And anything that has value is really because it is scarce,
right?
So I believe the number is around 200,000 or 220,000 tons is the total amount of gold that has ever been mined, right? And gold supply increases at a very marginal rate of 0.3, 0.4% a year. So we still have gold mining, but the total stock of gold is not increasing at a rapid pace. So if something is scarce, obviously it gets value, right? Fairly recently, till 1971, actually hard currencies were those that could actually be exchanged for gold, right? So till 1971, when Nixon broke the peg, you could actually go to the US government and change your dollar for a certain specified amount of gold. So that is why gold has always been considered a fairly good store of value and medium of exchange. In India, we of course have affinity for jewelry. So that also drives a demand for gold. And you gave some number of Indian affinity for gold, but just to kind of elaborate on that a bit more, of the 220,000 tons of gold ever mined, 25,000 tons is currently owned by Indian households.
Wow.
Right? So really 1/8 of the gold globally is owned in India. And value of that today is nearly $2 trillion.
Wow.
Right. So $2 trillion is what, about 40% of total market cap of India. So it is really a large asset class in India. In fact, in terms of jewelry, Indians own nearly 40-50% of all jewelry demand that has been there for gold globally. So it is a very important asset class for India, and I think it has served India and Indian household well over the years. It is an asset class that has beaten inflation over last many years, 10, 15, 20 years. It has even beaten returns on real estate, on debt. So it's actually proven to be a very worthwhile investment.
Great. Thanks, Ashish. You covered many aspects. So just to kind of break them and we'll then dive into each. The first one is that gold really started as a currency, as a mode of exchange. And as you said, it started as a mode of exchange because it was valued by everybody. So whether you are an Indian or a Chinese or a American or, wherever else, there is a value for gold. And the value for gold came because it had luster and so on and so forth. It was also very durable. It's not something that will spoil. And so all of these kind of combined together to make it a great way of exchanging value. And so gold started off there. And you referred, and we should go a little bit into that, the Bretton Woods, and you spoke about the peg of the dollar. So we'll kind of cover that as well. But at one point in time, the value of the currency of a country was pegged to the amount of gold that it had in its coffers. And so that was a way for people to get confidence. Actually, when currencies go out of fashion, then people, kind of move to gold as a way of exchange. So that's one area, and we'll dive a little bit into this. And second, we spoke of gold as an asset class, and you spoke of how in India it's a very popular one, but also that it has, kind of done well against inflation and so on and so forth. We'll go into a little bit of depth into that as well. So first, on the first side of things, can you talk a little bit about this entire Bretton Woods and the peg and so on and so forth?
Really, credibility of exchange rate, right? So credibility or the value of the currency were determined using gold, right? But the limitation of it, and as I spoke earlier, is that the supply of gold does not increase very rapidly, right? And every country and ambition is to grow fast, right? And there are various monetary and fiscal policies that drive that to achieve higher growth, right? So global growth has averaged at over 3%. But if you see the total stock of gold increases very marginally, less than at a 0.5% CAGR, right? So if you want faster economic growth, right? If you want faster GDP growth, you want your money supply to grow faster, at a faster pace, so at least in line with GDP, right? And that cannot be achieved if the stock of gold is not increasing at that pace, right? So this was one limiting factor, that you could not have your money supply being constrained just by the way, because what that would eventually mean is your global growth will become a function of how the supply of gold is increasing. Of course, more practically, governments wanted to run fiscal deficit, right? So, and if you are running fiscal deficit, you need funding for that. You need your central bank to print currency, and that cannot happen if they are limited by the amount of gold. So that is why finally the peg was broken, and we have had deficit financing coming in. And if you see, since then, there has been monetization or financialization of the global economy. So global GDP is today very broadly about 100 trillion, right? The total market cap of gold is, or the value of total gold that is out there is about 20 trillion. Right. So clearly global GDP is much bigger than, in fact, if you look at total stock of money globally, that is M2 is about 60-65 trillion. Right. So you needed to come about to support growth and growth ambitions, and I think that still continues, right? Because financialization is still continuing, monetization is still continuing. So you need money supply to grow at least at the pace of GDP, and that's why Bretton Woods got broken. And I think while still people want that They believe there's a debasement of currencies that is happening. They want, some hardliners will say that we should go back to a gold standard. I don't think it will happen because we have financialized much more aggressively. In fact, M2 is whatever, $65 billion. But if you look at the total value of financial assets globally, that's, and depending on how you calculate it, is 5 to 10 times GDP. So it's between 500 trillion to 1,000 trillion. I don't know what's 1,000 trillion called. Because so you have 100 trillion of equity market cap, debt market cap, derivatives outstanding, etc. In the light of this financialization, you could not have really gold as a limiting factor.
Right. So just kind of, so firstly, there was this Bretton Woods agreement, which was a post-World War II agreement. Before that, again, currencies were doing their own thing. But after World War II, kind of all the countries came, the Western countries came together, and they basically said that we'll peg our currency to the gold as a way to beat the hyperinflation that was happening at that point in time. And that helped kind of bring the inflation in control. But then they had these growth challenges. And so in the 70s, starting with the US broke the peg and so did everybody else. And then kind of the rest of the story you have already narrated. Fantastic. So very helpful to understand this. Ashish, now moving on to the kind of who are the people who, purchase gold and who are investing in gold as an asset class. So can you throw some light on that?
Okay, sure. So the biggest source of demand for gold is actually for jewelry, right?
Right.
So roughly about 45% of demand is from jewelry, and the annual supply of gold is about 5,000 tons.
Right.
And 45% of it is really going into jewelry. Lately, another big driver of demand has actually been the central banks.
Right.
So they have been annually taking between 15 to 20% of the global supply. And in fact, last couple of years, one of the reason gold prices have done so well is because of central bank demand. So they were buying 400, 500 tons, all central banks put together. And last couple of years, they bought like 1,000 tons. So that has been a big delta. So they account for about 20% of demand. Another 10% is investors, various kind of investors, including retail, who buy gold as a store of value in terms of gold bars and coins. Right. And that is becoming increasingly popular as well. So that's about another 10%. There is another 10-15%, which is what I would say financial demand of gold. So now ETFs on gold are very popular.
Right.
And I think today there are probably the total gold ETFs are about $300 billion worth. Right. So that is another. And then there is a small amount of demand that comes for technology purposes, etc. Right. So that is really the broad sources of demand. And I think jewelry demand, retail demand, and central bank demand are the big drivers.
Right. And so let's focus on the central banks a little bit. Like one understands why retail would buy jewelry.
Sure.
Because, whatever, jewelry has its own. It's more a consumption behavior. There is also some kind of investment mentality there, but it is mostly, you buy jewelry for consumption. Why would central banks buy gold?
So central banks maintain reserves, right? And so the first question is, why do central banks maintain reserves, right? So central banks maintain reserves for liquidity. So in a time of crisis, the central bank is supposed to step in. Central bank maintain reserves for trade payments, right? Central bank maintain reserves to give confidence and credibility to the currency, right? So even though there's no peg to the currency that you need to maintain, but you need to have certain assets so that because currency, the liability that the central bank has, so they need confidence and credibility. So if you look at all these functions, they are served by gold. Right. So because it can be used to make payments, it is really in times of crisis, if you need liquidity, and even India, you would recall in 91, use gold to kind of make payments or provide support to the currency. So all these function are served by gold, and therefore a part of central bank reserves always has been gold. Of course, the central bank behavior over time has varied. We had a long period from nearly 1980 to 2000 when gold prices did nothing. Right. Gold prices were flatlining or down. In fact, for 20 years, gold prices were like under $500. Right. And so there was certain amount of disenchantment because in one way, gold is an unproductive asset. Right. Because it is
there's only an interest as an example. Yes.
There's no interest income, right? And therefore, when anyone chooses to hold gold versus debt or equity, he is foregoing some income aspect. 1980s, you would remember US was fighting inflation, or Volcker raised rates, US rates that time were close to 20%. So clearly gold, the opportunity cost of holding gold became higher and higher. So there was a big period of kind of negative carry on the gold, and therefore central bank buying of gold came down. I think more recently, there has been factor that have been really triggered some of the central banks to more actively look at gold, right? India always used gold in its reserves, and its share of gold in its reserves has gone up from 5-6% to 9% in the past few years. But many central banks and some of countries with very large forex reserves like Korea, China, Saudi Arabia, Japan never really use much of gold in their reserves, right? And for them, gold as a percentage of their reserve was a very small 1-3%, and they have realized the importance of having gold, and they have been large incremental buyers as well. I think their change in behavior has come on, in my mind, on account of two counts. One is what happened in 2022 when Russia lost $300 billion of their forex reserves, right? Because their forex reserves were in dollar assets, and those dollar assets were confiscated once sanctions were imposed, right? So I think this geopolitical event put a fear out there among central banks that, okay, there's a this to this asset. So therefore, and so again, I forget the number, but Russian central bank has, I think, $50 billion, $60 billion of gold reserves. So at least that part of the reserves is secure. They lost the other reserves. So I think that prompted many central banks, including China, to aggressively start looking at gold as a part of their reserve basket. The second thing that happened around the same time as well, and as we talked about, it is also for the central bank a store of value, right? So whatever reserve asset they keep is a store of value. And everyone was using US treasuries as a store of value. And in 2022, they realized that is not the case. US treasuries is not a risk-free asset, right? Because as US rates went up, people had huge losses on these assets. And if you would recall, Australia, so RBA and the Swiss National Bank lost humongous amount of money, right? And I think SNB had a $140 billion loss that year. For the Australian Central Bank, actually their equity got wiped out. So for positive, they went to negative equity. So people realize that over-indexing on just one asset class is also not the right approach, right? So I think these two factors triggered a shift more towards gold within the central bank reserve assets.
Right. So again, Ashish, we covered lots of spaces in this answer. Just to kind of compartmentalize it, first is central banks need to hold reserves because otherwise there could be a run on the currency or there could be a loss of confidence in the country itself. And so they hold, like India as an example has more than $600 billion of reserves.
Yes.
Many of them are in US treasuries, but some of them are in other developed market treasuries, bonds, and some of that is in gold. This composite of assets ensures that if tomorrow somebody comes and challenges, let's say the Indian currency or whatever, the central bank can step in, and then because central bank is stepping in, then people have confidence that look, India is not going to default, and so on and so forth. And so they have to hold reserves. Traditionally, everybody held US dollars as reserves. India always had some gold, but in 2022, two things happened. As you said, one is this event wherein the US put sanctions on Russia and said Russian assets held in any other currency, basically we will not allow Russia to access. And so they lost very large amounts of reserves. And that brought a crisis of confidence in some manner, saying that is US dollar really a reserve? Sure. Or is it something that makes us geopolitically vulnerable?
Yes.
And the second thing that happened is that US for the last 15 odd years has been running a near zero interest rate policy. And so US bonds would give you 0% yields. In 2022, they hiked the rates quite dramatically. And when you hike yields, the price of the bond falls because the two are inversely correlated. And hence, if you were holding zero yielding or near zero yielding US treasuries, in 2022, the value of these bonds fell very steeply.
Yeah. So some of these bonds lost like 40% of their value.
Lost 40% of the value in a year, which is unheard of for a government bond. You could have this in mid caps or something, but not in like that to US treasury, right? And which is where again many countries basically said, look, this is not the right thing to do, so let's put it in gold. And so central banks have been for the last 2-3 years been buying lots of gold, and it's a trend that likely will continue as well. Yes. Now moving on to the next question, Ashish, is what determines price of gold?
So I think that's an interesting question because I think there are several factors, right? So we said demand comes from multiple sources. It comes from jewelry, it comes from demand for coins and bars, it comes from demand from currency, it comes from investors who are buying ETFs, etc. So historically, we have seen two very important determinants of demand as well as price of gold. One is interest rates, right? So typically, as we discussed earlier, when interest rates are high, particularly real interest rates are high, demand for gold comes down because opportunity cost of holding gold is high. And similarly, when interest rates are low, people are more willing to hold gold, right? So one is your real interest rate. The second is actually the fear or the risk factor in the world, right? If you see any crisis that happens, any economic, any geopolitical crisis, right? The safe haven asset is gold, right? So whenever the risk levels go up, there is a big kind of pull in for demand towards gold, right? And increasingly, the safe haven factor of gold has been the overriding factor, right? Because now, as we discussed, there's been huge financialization. So even households, institutions, everyone is investing. So when uncertainty goes up, when risk goes up, people who are invested in stocks, bonds, want to go to a lower. So everyone kind of moves towards gold, right? And now you have all these gold ETFs also that you can move towards. So I think one of the biggest drivers of gold demand is risk of fear, right? We talk about how central bank demand for gold increased in the last few years, and actually that is also driven by the same factor, fear, right? So they had two fears that played out. One was fear of losing your asset because of geopolitical reasons, and the second was a fear of erosion in the value of the asset you held because interest rate went up, right? So I think fear is the biggest factor that kind of drives it. If we look at price driving, so jewelry, which is the largest component of gold demand, that actually has a negative correlation. So when gold price goes up, naturally the demand for jewelry actually comes down. But many of the other factors are actually not so correlated with the price, right? And sometimes price goes up in the times of heightened risk or heightened uncertainty or geopolitical turmoil, and actually demand for gold also increases at that point of time. So I think there are balancing factors in gold demand. In fact, this year we have seen as prices of gold has gone up, flows into gold ETFs have only increased. Right, we discussed central bank demand for gold actually increased. Right, in fact, demand for gold, physical gold for the investment purpose in forms of bars and coins also increased. Right, the only kind of offsetting factor was demand for gold for jewelry purposes came down.
Correct. So basically you spoke about two main things that drive rates. First is the real interest rate, which is real interest rate is actual interest, nominal interest rate minus inflation. So basically it's a combination of both the interest rate and the inflation.
Yes.
If the inflation environment is kind of a high inflation environment, then gold prices go up.
Yeah.
Because gold is also considered as a hedge for inflation.
Yes.
On the other hand, if interest rates go up, inflation being constant,
yes,
then gold demands come down. Gold demand comes down because if you were an investor and you had 100 rupees to invest and one was giving you 5% and the other was giving you 0%, you will typically put it in the 5% bucket.
Yes.
All other factors remaining constant. So higher interest rates, lower demand for gold, higher inflation, higher demand for gold.
Yes.
And so one is the subtraction of the two in many ways. And one reason why we've seen gold prices go up in the last year or so is because inflation expectations also went up quite dramatically in the US, and so there was a thing there. The second one, which is very interesting, is it's not how should I say? It's not mathematical. It's not a rule, but in general, because gold is a confidence asset, if the confidence in the global environment falls, then gold prices go up. So if there is a war, if there is any kind of big macroeconomic event, etc., gold prices will go up because people will naturally gravitate to gold as a quote unquote safety asset. And because gold has played this role for maybe thousands of years, there is this kind of belief that it will work, even kind of if, let's say, major currencies were to fail, etc. There's a third one, which is, Ashish, important only for Indians, which is the exchange rate. Because dollar prices are determined globally.
Yes.
And so if the exchange rate fluctuates, the price of gold also will fluctuate. So maybe...
So Samir, the exchange rate or depreciation of the currency, a factor for investors' demand into gold, not just for India, but actually globally. In fact, another place where the individuals are large holders of gold is, for example, Russia.
Right.
And one of the reasons is, I think Russians have lost their wealth in bank deposit twice in the history.
Right.
Right. So I think value of currency and the risk of depreciation of currency is a factor across a lot of emerging markets as well. And so the returns on gold have come partly also because your currency depreciated. Right? So if you looking at this data some time ago, that last 25-year return on gold has been 15% in India, right? But if you break it down, how much is gold prices versus how much is INR depreciation? So actually, INR depreciation is only about 1/3, 2/3 has been increase in price of gold as well.
Right.
And I think this holds true for virtually every currency, including even dollar investors, right? So if you go back to the thesis we had, that broke the peg to the gold because you were printing more currency than gold prices. So one of the reasons why even in dollar terms the value of gold has increased is because more dollars are being printed than gold is being produced.
Right.
So I think and that's why it's an inflation hedge, right? So if you go to a monetarist theory of inflation, it says inflation is because there is excess money, right? So if your, say, supply of goods in a very simplistic one commodity model of economics, so if supply of goods is increasing by 2%, right? And your stock of money is increasing, let's say, by 5%, right? That gap is increase in price, right? So that 3% in inflation and 2% is whatever real growth in production, right? And therefore, as long as the supply or printing of currency is happening faster than the increase in the stock of gold, you would expect the price in currency terms to increase, right? And I think today there is that debate as well, and I think you have discussed this in your earlier episodes about the value of dollar, the US fiscal deficit. US is printing so much currency, so how does US dollar also retain its value? And the reason is we are questioning that is because there is so much of deficit financing that is happening. And so I think it's one, the debasement of currency is really a one principal factor that will continue to drive the price of gold. I think there is no choice with how the economies are now structured that you will continue to print more and more. I think all governments have got very comfortable with deficit financing for growth, and US increasingly so over the last few years. So we don't see that going away. And what it means is that it will be positive for gold prices going forward as well.
Great. So three sources of value: the real interest rate, the macroeconomic uncertainty, and the rate of depreciation of the currency. All three included is what gives us the price in India. You have referred to the returns on gold. So maybe we move on to that section and talk about how gold has performed as an asset class. And there is this, when I was younger, my parents would invest in, like every Dhanteras, they would buy gold and so on and so forth. And there was this traditional thing that, it is good for safety. When I started working, there was this strong thesis that you should not put money into gold because gold doesn't, you should put money into equities and so on and so forth. So now these are all obviously stories that we've heard. If you can enlighten us on how gold has performed as an asset class.
So I think, again, if I look at 30, 40 years, it's been a journey where there have been extended period of time where gold had done nothing, and then there have been period of time when gold has done well, right? And I think a lot of the anecdotes we hear, the investment hypothesis we have, is determined just by recent experience, right? So I think again, in the 1990s, the reason all of us were told gold is not a good investment class, it's an unproductive asset, was the fact that gold had done nothing for 20 years. Right? And actually, after 2000 till date, in fact, if you see the return on gold versus return in Berkshire till I think 2023, Berkshire stock was actually similar. Right. So I think we take a cue from history. So if 10, 15 year history is saying something, we just kind of extrapolate that. I think if we kind of step back and today's environment where we see globally geopolitical risk heightened, right? So there are multiple hot wars that are on at this point of time. We look at the fact that now literally post-COVID fiscal deficit is not being considered a bad thing. Literally every economy is going for larger and larger fiscal deficit. I think it certainly means that you will need people to gravitate towards some hard asset, right? Now people have talked about de-dollarization, but the biggest challenge to that is that there is no other kind of reserve currency, right? You have challenges with the euro, and there is no real kind of third alternative, right? So where do people gravitate towards? And I think gold therefore becomes really one important, as we say, store of value, right? I think new age Gen Z probably think it is Bitcoin and not gold, right? So I think those are probably things people believe are stores of value that will not be debased by expansionary monetary policies. So my actually belief is that as long as even if interest rates stay high, as long as the pace of money supply creation remains excessive, as long as governments run high fiscal deficit, you will see a gold as an asset do well.
Right. So great. Thanks, Ashish. So just kind of to put some of these numbers, you mentioned this gold has over the last 20 years returned about 13 odd percent. Nifty in the same time has returned 15%. And debt obviously has been lower, right? Maybe in the 7.5-8% kind of range. So has real estate. So gold has actually done better than inflation. Obviously, it has done better than real estate. It has also done better than debt. It has trailed equity, obviously with much lesser volatility in the asset price itself. And 15% obviously is very good. 13% is not that bad actually.
Yeah.
So at least in the last 20 odd years, gold seems to have performed quite well. In these 20 years, again, there are times when, the price zoomed up, and then there were some years where the price didn't do that much. But overall, reasonably long this time, gold seems to have delivered decent returns to investors. To your point, that doesn't necessarily mean that in the next 20 years it will do well. But there are reasons to believe that it will continue to appreciate because of the debasement of currencies and, the fact that no currency is in short supply, and it seems to be kind of getting in more and more supply, whereas gold actually is in short supply, and so that's one reason for gold to continue to appreciate. Last question is on this. You mentioned Bitcoin, and so Bitcoin is supposed to be the new kind of the digital, quote unquote, digital gold, right? So what are your views on this?
I am actually not convinced that on what is cryptocurrencies, how acceptable they will become, etc. Right? Because I believe currency monetary system has to be driven by the central bank, right? And this is actually crypto says that it is an antithesis to central bank. So I think there are believers in it. I know it's kind of gaining more and more acceptability. In fact, we talked about the fact that total value of gold outstanding is about 20 trillion. I think the total market cap of Bitcoin alone is now 1 trillion, 2 trillion actually.
Wow. Okay.
Right. So, and I think Ethereum is another 500 billion, etc. So I'm sure if you add all the cryptocurrencies, you are getting to a value which is a significant percentage of total value of gold outstanding as well. Unless governments and central banks recognize cryptocurrency as a true asset, I am not sure how it will kind of come into the mainstream financial system, right? And again, what will drive the value of that asset? Is it, as we spoke about, just as a substitute to gold, just a safe haven asset, or there is any other kind of value that will be ascribed? At least in case of gold, we spoke about that about half the demand comes from demand for jewelry, right? So you can actually say, let's say if the fear factor goes away, right? So some of the safe haven demand for gold comes down, gold prices come down. And as we discussed earlier, when gold prices come down, demand for gold for jewelry will increase, right? There's a substitute. In case of Bitcoin, if people are not buying Bitcoin as a safe haven, if that demand comes down, what is the natural driver of Bitcoin demand? So some of these things, at least for me, are unanswered. So I'm not sure what's like the future of cryptocurrencies.
Fantastic. Ashish, thanks a lot. It was a great conversation. Gold is a kind of fascinating topic because it goes back many years, many centuries actually, as a store of value and as a currency. That's when it started. Because it goes back many years and it is durable, and there is acceptance of gold across the world. It's become a de facto kind of a de facto currency or de facto store of value.
Yes.
We discussed that there are four main sources of demand. So there is the jewelry source of demand, there is a central bank, there is the investment source of demand, and then there are the industrial source of demand. The first three obviously are the main components. Jewelry demand, we discussed kind of it falls as the price goes up and increases as the price goes down for obvious reasons. Whereas for the other classes, it's the other way around. Actually, typically when the price goes up, the other investors tend to put more money into gold, and when the price goes down, they tend to draw more money out of it. We discussed the evolution of gold, and in that context, we discussed the entire Bretton Woods and how the peg to the gold was then kind of taken off, and how since then governments have financialized. And one of the reasons for the gold price to increase is that the stock of money increases at a faster pace than the stock of gold. And hence, so gold becomes more and more expensive because this correlation at some point has to be maintained. We spoke about the factors which drive the prices of gold, and there we spoke of three things. We spoke about the real interest rates, which is a combination of the nominal interest rate minus the inflation, and so both kind of determine gold prices. The source of the uncertainty and the volatility in the world around us, because gold is a confidence asset. So if the confidence in the world is lower, then the price of gold is higher, and vice versa. If everything is stable and so on and so forth, then the price of gold will likely go down. And obviously the third one was the exchange rate and the debasement of currencies. We also spoke about gold as an asset class. It seems to have done reasonably well actually over the last 20 years. It has beaten inflation, it has beaten real estate, it has beaten debt. So only equity seems to be an asset class that has done better than gold. So not bad actually. And finally, we discussed alternative to gold as a safe haven, which is cryptocurrencies, where we discussed that the jury is out. There are believers in cryptocurrency, but frankly, when a real crisis hits, will cryptocurrency be a source of value, a store of value, or will confidence in that also plummet, given that there is no real big government or central bank backing it? So we covered a large amount of areas. Ashish, thanks a lot as always for this conversation. I hope you enjoyed it as much as I did.
Yeah, thanks.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.